Dear students, in the previous class, we discussed about the financial system. Here, we are going to discuss about the RBI's role and functions, regulation of money and credit, monetary and fiscal policies, and financial reforms in India. We have two regulatory systems. One is multiple regulatory system. Then we have a single regulatory system. Then every regulatory system has its own advantages and disadvantages. But in general sense, if you observe in India, we have a multi-regulatory system and there are multi-regulatory bodies which exist to regulate the different type of institutions and markets. So out of all, the Reserve Bank of India is the one which is the oldest regulatory body and regulates the commercial banks. And the commercial banks is the most important financial organization or financial institution in Indian system as well as in the other system. That is why let us start the discussion on how commercial banks are regulated and what exactly is the role of RBI to regulate this commercial bank and what is the basic role of RBI of India, what is the structure of RBI and how it basically functions. So this is the best objective of today's discussion. Let's start with what do you mean by RBI and when was it established and the structure of the organization, and then we are going to move to the functional part. You see, whenever we talk about RBI or the structure of RBI, as I already told you, Reserve Bank of India is the central bank of the country. It is the center of the Indian financial and monetary system. All kind of financial or monetary mechanism basically works with RBI of India or starts with this as the apex body who takes care of monetary and the fiscal aspects of this particular country. This functioning of RBI started from April 1st, 1935 on the terms of the Reserve Bank of India Act which came in 1934. That is why it is one of the oldest regulatory bodies which is working in the Indian financial system. And whenever you talk about the structure, all of you very much are aware about that the head of the organization is governor, right? And governor, there are 4 deputy governors who always work on behalf of Reserve Bank. They are appointed by the central bank, by the central government. How the bank is managed is, the banks are structured like this. The bank is managed by a central board of directors and 4 local board of directors and a committee of central board of directors. And this is the way there is a central board of director who basically works after the different policy issues and what is inside whenever we go to the system. We have what we have seen is that the hierarchy is like this, right? So we have the governor, we have 4 deputy governors, and each department is basically aided by executive directors. Then the other bodies work in a particular system. But if you see RBI, the final control of the bank basically rests upon the central board, which comprises of 4 deputy governors and 50 directors nominated by the central government. So there are 15 directors who are not part of this particular bank. They are specialized people or the expert people from different areas. And the deputy governor and governor obviously a part of central board, and that is why this Reserve Bank of India basically functions and inside hierarchy. If you go that after governor, deputy governor, we have executive directors and the directors, the other people, and they always work for the functioning of RBI. At present, it is always subject to change. But presently, Reserve Bank of India has 26 departments and 28 regional offices which work to regulate the financial system or monetary system. As a whole, we can say because the bank is the most important organization which always we observe in the financial system. So this is the way the structure of RBI basically looks like. Um, the objectives of RBI. RBI is established long back in 1935. So what was the basic objective now, and what is the objective, whether there is a change? So if you see overall here, what really I've summarized that over the period of time, what are the broad objectives of RBI and how RBI is working in this particular system and what basically they are trying to do. The first and the foremost thing is RBI does is to maintain the monetary stability. So whenever you talk about monetary stability, you see that whenever if you remember economics, we have monetary policy and we also have fiscal policy. And whenever we talk about RBI, RBI takes care of monetary policy and the government takes care of fiscal policy by that is the finance ministry is responsible for the conduct of fiscal policy. So, as the responsible authority for smooth conduct of monetary policy, RBI always ensures that monetary stability of the economy is maintained. Whenever you talk about monetary stability, the monetary stability means we're talking about the price stability. So the basic objective of RBI is to make the price level stable. That is in a particular period of time in a particular country. So this is the first objective on the basis of RBI for which the RBI was established. Second is to maintain the financial stability and ensure sound financial institutions so that monetary stability can be safely persuaded and economic unit can conduct their businesses with confidence. It is a very broad objective, you see. What you do mean by what you when okay, let's understand what is financial stability. Now financial stability is a buzzword, right? Particularly after the crisis, people are more concerned about the financial stability, but already what again and again comes to my mind is that whenever you talk about financial stability in the Indian context, it basically is stability of the banks mostly. So if the banks are stable, capital base of the bank is basically adequate and enough to observe all the types of risks that we are facing, the bank, then automatically we can conclude that financial sector in the Indian context is stable. So what RBI basically tries to ensure is RBI tries to ensure the financial sector should be stable, at least the banking sector should be stable, the should be able to stable the credit risk. So the instability of the banks and failure of the banks should be minimized as banks is the payment gateway of this particular system. So here what is happening, the banker stable, banker stable automatic, what will happen, the monetary stability can be maintained and the people have the confidence on the market. And all of you know that the behavioral aspect is quite important for the function of the market. So if the consumer's confidence or the people's confidence on the market will be more, then automatically what will happen, the functioning of the market will be smoother, and the operations and all those activities which is happening in the system will basically work in a better way. So therefore we have to ensure that the financial stability should be there. Financial stability means stability of the banks, particularly the most important organization in the economic system. Then once this is stable, then the monetary stability can be maintained. The consumer confidence and people confidence will be higher than the market and will be working in a better way so as to ensure or to maintain the stable payment. The financial transactions can be safely and efficiently executed because already you know that the commercial bank has the only payment gateway or the most important payment gateway in the particular system. Then RBI ensures that the payment system should be stable. There should not be any kind of hassles in terms of transactions. So if the transactions are hassle free, people will have confidence on the market. The confidence of the people will be more in the market. And if the confidence of the people is more, automatically what will happen? That the safety and the efficiency of all kind of transactions that are executed and the participation will also increase. More the participation obviously will tend to be more efficient, will bring more efficiency in the market, because market will become more competitive. And if the market is more competitive, in that sense, whatever price or whatever economic output what we are determining, that will be actual equilibrium output and what we can get. So therefore the stability of payment system is one of the most major or most important objectives of RBI. And another important thing is to promote the development of financial infrastructure and to ensure or to enable them to operate efficiently. So here what we can say is that what do you mean by financial infrastructure? Financial infrastructure means establishment of new banks, establishment of new branches of the banks, of the commercial banks, establishment of different organization which can help in trading, right? As well as increasing the efficiency of the market, like the example of CCIL, the Clearing Corporation of India Limited, which was established by RBI for trading of the government debts, and as well as to some extent the foreign exchange and the derivatives instrument to some extent, not derivatives mostly, it is related to government debts that are there. So that that is why RBI's basic job is to mostly deal with establishment of new infrastructure which can help for the functioning of the market in a much better way. Another one is to ensure credit allocation, right, by the financial system, because it reflects the national economic priorities and social consensus. You see, whenever the commercial banks give loan, whom they are giving loans? They are giving loans from where they are maximizing their benefits. They give loans and try to find out the customers to whom they can get more returns. So it's like a business. It's a commercial business. So, but that may not also fulfill the social objectives, right? There are some small units like small farmers, small business units. So they may not be able to pay much of the money or that much of a kind of interest rate what bigger commercial banks are able to pay or commercial units are able to pay. So then if there is no regulation, there is no such kind of norms which are there where this lending also, the credits also should be given to these kind of entities than those entities which can be marginalized. And those entities cannot grow in particular system, because the Indian economy is mostly based upon rural economy and most of the people live in the rural areas. So as long as before our maximum percentage of the share of GDP is coming from agriculture sector. So keeping that in mind, the commercial banks should provide the loans to these kind of sectors. The RBI also make policies which is basically related to societal concerns. At a time, all kind of sectors should grow simultaneously. We can say that is the basic objective, the basic notion or the motto of Reserve Bank of India, and to regulate the overall volume of money, right? And the credit in the economy with the view to ensure reasonable degree of price stability that already has been explained to you, because monetary stability leads to price stability. So that is the basic function or the main broad objectives on which the basis of RBI was established. So now we will see how this RBI basically functions. There are many functions RBI does. So here in this lecture, we will highlight some major functions of what RBI follows. You all know that, right? RBI is a note issuing authority. Whether RBI issues a note or not, every common man or everybody is able to know that after this, the demonetization and all these things, everybody was watching and reading in the newspapers that RBI is trying to change this note and they are going for the new 500 notes and all these things, or 100 rupee notes, etc. So if you see, obviously the basic functions of RBI is the first and the foremost important function is issuing notes, the currency. and it has the authority except 1 rupee coin. So 1 rupee coin is not basically made by RBI, it is issued by Finance Ministry, right? So there are other than this, there are 10 rupees, 5 rupees, 20 rupees, 2000 rupees. These are the denominations which are existing in the system. So now 50, 10, 20, 100, 500, 2000. So only RBI has the authority to issue notes other than 1 rupee notes, and the coins that is already mentioned, like I told you. So the primary function of RBI is to issue notes and note issuing authority, and it's also the government's banker, because RBI is a banker to the central and state governments. It provides all kinds of banking services to government, such as acceptance of deposits, withdrawal of funds by checks, making payments, as well as the receipts and collection of payments on behalf of government transfer. So the transfer of the funds and management of public debt, all kind of banking operations, what we do with the commercial banks, the same kind of banking operation the RBI of India does with the central bank as well as the state governments. So anytime the central government needs money, they can borrow it from RBI. Anytime central government has some reserve money, they can keep it with RBI. Any kind of forex transactions, everything and anything what the central government tries to do or any other state government tries to do. So every kind of banking operations is done by RBI. So RBI of India is why popularly called as government's banks, or it is government's banker. This is the reason. So in that constant, what we say that without our reserve bank, the financial transactions of the central government may not have been possible. In a holistic way, the country's banks is a, or the central bank is basically RBI at the time of the requirement. So they provide money at the time of surplus, they deposit money, and they also act like agents on behalf of central government. So whenever the foreign transactions are made, so this is the way, this is the reason why they are called as government's banker. Then another function of RBI, as I already told you, they manage public debt. They play a very effective role, for management of the public debt. So how they manage? Reserve Bank of India basically manages the public debt and issues new loans on behalf of central and state government. So it involves issue and retirement of rupee loans, interest payment on loans, operational matters about debt certificates, registration. When we say registration, it means that whenever any kind of loans is taken by the central government or the state government, mostly it is central government. All the loans are basically taken through RBI. So whenever they want to raise money from the public, they sell the securities through RBI on behalf of government. The government securities are sold by RBI whenever they try to extract or try to absorb the money from the market. What do they do? They sell bonds and they get the money, right? And whenever they try to inject or induce money into the system, what do? They basically buy the bonds from the public and give them money. So either buying or selling of bonds increase the money supply, decrease the money supply, and management of debt from different agencies. All these things of the government are done through RBI. So they play a very active role in the management of public debt. What is done by, or a basic job is done by the RBI. So RBI plays the most vital role for the smooth functioning of public debt management system in the country. Then it's obviously called as banker's bank, right? So whenever any commercial bank need money, from where do they get the money? They get it from RBI. So if you see, banks basically controls the volume of reserves of commercial banks, and thereby determines the deposit and credit creating ability of the banks. You might have heard, whenever there is a change in policy by the RBI, it affects the functioning of commercial bank. Why? Because through that commercial bank, it tries to So we will discuss about more about this when we are talking about the instruments or the policy instruments where RBI uses it as a matter of control to the money supply and make the prices stable. So that it will come later. But here, what we are trying to say is that RBI controls the commercial banks like State Bank of India, Punjab National Bank, Syndicate Bank. So all kind of banks which are there through different ways, to different mechanisms, to different instruments. So therefore, what RBI basically allowed, the Reserve Bank of India opens the current account in banks, right? In the banks with itself, and it enables the banks to maintain cash reserves as well as carry out the interbank transactions through these accounts. So every commercial bank can interact with another bank. They should maintain a certain kind of cash reserve. And with RBI, that is why in a term called CRR, the basic objective of CRR is to determine the to decrease the probability of default of liquidation of the banks in the future. Although it does not carry any interest, we'll discuss about this more later. So here you see every commercial bank has an account with RBI. So whenever they need money, they can borrow from RBI through different ways like liquidity adjustment facility, repo operation, etc., etc. So, and whenever they have surplus money, they can also park their money with RBI, and interbank transactions can be settled by transfer of money through electronic fund transfer system, which is basically real-time gross system, which is operated through RBI. So every commercial bank has an account with RBI, and all the transactions which they make either through interbanking system or this access reserve this access reserve, whatever they have, any kind of excess money. So what they want to borrow from RBI, everything is done basically from RBI itself. So therefore, whenever the commercial banks are in security of the money, or whenever they have surplus of the money, they depend upon RBI because they are called bankers bank. So RBI is the bank of all those bankers. That is basically another function of RBI. So that is why they are the most important organization in the financial system, particularly in the Indian context. As I already told you, the regulator, they are supervising authority. So what kind of supervisor is RBI? So what kind of jobs do they supervise in this banking system? It issues the license for these establishments of new banks. You might have known those 2-3 years back, we have there are many private banks who got the license. So only RBI has the authority to issue these licenses. By going through the process, they have to see whether this particular entities are able to do banking operations or not, right? Banking business or not. So keeping those things in mind, what they can issue the licenses is for establishment of new banks. Even any bank, whenever they want to set up a new branch, for that also Reserve Bank of India provides the licenses, and the licenses have been given after this thorough mechanism, or they are going through the actual process, whether the banks are fulfilling these criteria or not. And this RBI ensure that this particular bank is able to fulfill these requirements, then only the license can be issued to them. So it prescribes the minimum requirement regarding the paid up capital and reserves transferred to the fund maintenance of cash reserves and other liquid assets. You see, how much loan one individual can take, that regulation is made by RBI. So how much industrial loan can be directly given by commercial bank? And if more than that, how much money should be above the limit and above which the monetary limit of RBI should interfere, or commercial banks should take the permission from RBI. So this is basically done to have a very smooth control of operations, or to make this financial system more stable. It also inspects the working banks in India as well as abroad. in respect of their organization, set up branch expansion, mobilization of deposits, wherever the money is invested. So, what is the credit portfolio management system they are doing, right? And how much money can be recovered? How much is the NPO? What is the performance of the banks? What kind of credit planning the banks are doing? What kind of manpower planning or training the banks are doing, right? All kind of integrity issues which are responsible or what is important for the commercial banks, those are basically supervised by RBI. So it conducts the investigation from time to time into complaints, irregularities, or frauds in respect of these banks. All kind of frauds, basically, if any kind of irregularities which can happen. So, for all these things, basically, investigation is done by RBI first. So it controls the appointment and reappointment, termination of chairman, executive officers of private sector, because public sector banks, CEOs and chairmen are appointed directly by the government, right? So RBI is responsible for the private sector banks, and RBI's approval is very much required. It also approves the force the amalgamation, means actually if some of the banks are not functioning well, their performance is not basically good, right? The RBI can tell them to merge, or RBI can tell them from particular banks to merge together and get rid of such problems and improve their performances in future. So that is what basically is what we're talking about, supervisory roles. Another major function is exchange control. So RBI is the exchange control authority, because all the forex transactions in India is done through RBI, and it only administers the forex control. So in today's exchange rate system, mostly India follows a managed exchange system. So if there is any kind of instability in the exchange rate fluctuations, then RBI can intervene into and control that. It also manages the forex reserves, whatever we have, right? So it has also the responsibility to interact with all those financial bodies like, IMF, World Bank, Asian Development Bank, etc., etc., for any kind of suggestion or any kind of functional relationship in the time of the requirement. RBI has the authority to do that. So it is also responsible for formulating the prudential norms. RBI formulates various norms to create and maintain an efficient functioning of the financial system in India. So all those kind of markets, disciplines, all kind of regulations with respect to commercial banks are created by RBI. It can give, so if I give an example in terms of market discipline, the commercial banks are always directed by RBI to disclose their balance sheet in a periodical basis. So if they do not disclose that balance sheet, then the adequate amount of fine or penalty can be imposed upon them. So like, what are those disclosures? What are the things that we should disclose? What are the things which is beneficial for the shareholders and all kinds of other stakeholders of a particular bank? So for everything, the rules and regulations or the norms are basically maintained by RBI. And RBI also ensures that it should follow this. The CRR should be maintained, and as well as they should maintain this capital adequacy ratio norms, which is given by Basel. So all kinds of or all kind of things, norms, basically always monitored and regulated by RBI. As I already told you, these are the promoter of the financial system. They help in mobilizing the savings. They also render the So they help in mobilizing the savings. They also render the developmental in promotional services, and it establishes, like I already told you, it establishes guidelines to promote or provide these loans to different priority sectors. And also RBI can establish different specific organizations to develop particular sectors, like NABARD. So NABARD was established in 1964. by RBI to promote the agricultural sector, because the agriculture sector was not that developed. So specific organization has been established to develop that particular sector. So like that there are different kind of organizations that are set up by RBI to promote the particular entities which are not developed in that particular system. It regulates the supervision by the payment system. It created a board of regulation and supervision of payment in settlement system as a committee of central board. So your new department called new Department of Payment in Settlement System was constituted to assist this particular committee in performing. So these functions, obviously it conducts the monetary policy, which is the most important and vital thing what the central bank does, because from the beginning we said that the monetary stability is the prime objective of financial stability of the RBI. So that is how RBI conducts monetary policy. So how they will ensure that price can be stable, or how they can ensure that banks should be run in an efficient manner. This is the way, basically. That is why RBI is the regulator of both money as well as credit. So the most important job of RBI, if you all see overall, three things. They do not create the rules for the banks. They monitor the exchange rate and they control, they are the exchange rate controlling authority, and the all kinds of transactions, foreign exchange transactions basically are drawn through them. And the most vital thing is they are the government's bank, and they are also bankers bank. And the most important thing is that they are the implementer of monetary policy in our system, and they conduct the monetary policy in such a way that the monetary stability and financial stability can be enforced. So in the forthcoming class, in this session, we will be discussing about the instrument of monetary policy and how RBI conducts monetary policy to make this price level stable and increase the output of the economy. So, as we've already had a discussion on RBI, its basic functions and the objectives, one of the major objectives is to conduct the monetary policy, because as you all know that there are three different measure or major policies that you always observe in the functioning of the economic system. One is your monetary policy, second is your fiscal policy, and third is your foreign exchange policy. So this monetary policy is totally regulated and controlled by the central bank. And Indian context, this is the Reserve Bank of India. The fiscal policy is controlled by government, and the forex policy is also governed by RBI. So there are three major policies that we always see. So today we'll be discussing about the instruments. We'll also discuss about the instruments what the central bank RBI uses for the conduct of these monetary policy. So there are certain basic objectives of monetary policies in the actual sense. So as you all know that the basic objective of monetary policy is to increase or accelerate the economic development in an environment of reasonable price stability. Because if you see that there are always we have two objectives. One is your price stability and other is increase in the growth rate. So, but particularly in the country's context, we call it as GDP. That is the growth rate, but the price stability and the GDP growth rate basically does not go together. So if you see an example, so if there is a change in the interest rate, so if we are declaring that the interest rates, what will happen? The money supply will increase because more banks can provide the loan, and more the demand of loans will be there. The money supply will increase, then the investments will increase. If investments increase, the outputs will increase. The output increases, then obviously the growth rate or the GDP increases. But at the same point in time, if your money supply is increasing, it also increases the price level. So that means there will be inflation. So that is very tricky for RBI. right? So whatever the way the monetary policy can be implemented, by that both price can be stable, or the price stability can be maintained, as well as the economic growth should also not be hampered. So this is the major objective, whatever we have in terms of monetary policy. And the second one is to develop the appropriate institutional setup to aid this process, and how this particular process will work, because there is a channel which works in this particular context. And for the smooth function operation of this particular channel, we need one appropriate institutional setup, and RBI in India is responsible to see that in this context. So how the commercial banks are working, what are the effectivenesses of the bank's credit channel in this particular system, and all kinds of institutional setup are always looked upon by the central bank for the smooth conduct of monetary policy of that particular country. That is also another thing we have to keep in mind. So then another objective of monetary policy is to achieve the financial market stability. And again, I'm telling that the market has to be stable. That means, you see, in general sense, stability means what? Ensure that the market should be fluctuating and shouldn't be that volatile. Why volatile? This is a desired concept. Unless the market is not volatile, people will not be interested to invest in the particular system. So volatility is required to a particular level and within a particular range. So let the volatility be accepted to a particular range, but beyond that limit, the price, if the price is fluctuating, we can say that the market is unstable. That means too much of volatility leads to instability. So volatility is a desired concept, is a desired phenomena. But whenever we are talking about too much of volatility, then it is basically an undesired concept or undesired phenomena. So basically, in the true sense, volatility is required, but whenever we talk about instability, it is basically undesired. So one of the basic objectives of monetary policy is that they can control that particular volatility. By that, the market can be stable. So these are the three major objectives of monetary policy in India. So if you see next how the framework of monetary policy in the India basically works, already like we've discussed, monetary policy basically works in a particular system. There is a proper framework which is existing for the conduct of monetary policy. So again, going back to my discussion, that whenever you talk about the policy, there are two debates. The basic instrument is we have to change the money supply. If money supply can increase or decrease depending upon the investment output, the price stability of these things basically get affected. So the question here is whether the money supply is endogenous or is exogenous. So what do you mean by endogeneity and exogeneity? Endogeneity means basically it depends upon some other variables. So if you want to change, then how this particular endogenous variable is determined, then that is y. Then y should be the function of x, and here x is basically what is exogenous variable, which can be controlled by regulator. So if you want to change y, then you have to change x. So therefore the question is whether money supply is endogenous or exogenous. So if you go by the economic theories, there is a debate that whether the money supply is endogenous or money supply is exogenous. So according to the Keynesian framework, money supply is exogenous. Whenever the regulator or the central bank, they can change the money supply on the basis of the requirement to control the price or to increase the growth rate. But the question here is, in the true sense, if you see, money supply is not exactly exogenous. Money supply cannot be exogenous. Then why this money supply can't be exogenous? If you talk about our country, there are two factors which affect the money supply. But this is not in the control of regulatory bodies like RBI. So one is the inward remittances of the foreign exchange. So how much foreign exchange is coming to India? They disclose the requirement of credit for financing and the purchase of food grains. But the requirement for credit for financing the purchase of food grains, that depends upon various other external factors like monsoon. Then the demand for that particular food grain, all the things. So how much production will be there in a particular point in time, whether the particular country has to buy the extra product or particular is an excess amount of product which has been produced. So there is a different factors which are responsible for this. So RBI or any other central bank cannot decide how much money is required to buy at that particular point of time, and how much loan can be given or should be given to procure that amount of product, particularly the food grains. So this is not in control of central bank or RBI. And another is how much forex is coming to India in that particular period, and what are those two variables and how they impacted the money supply. So in the practical sense, if I tell you, the money supply cannot be exogenous, at least for Indian context, right? The total money supply cannot be controlled by the regulator. So if the money supply cannot be directly controlled by the regulator or cannot be changed by the regulator, it then basically means we are thinking what we are thinking. We're thinking of a framework, and how that particular framework looks like. If you see, this framework, we have a framework like this. We have to change certain instruments. There are certain instruments that are used to change the money supply. So these instruments have impact on money supply, or on here the money supply, the bank credit are the intermediary targets or intermediate targets. So these are two variables which are intermediate variables in our context. So finally, the money supply gets changed and the bank credit gets changed, or the bank credit mean the amount of loans where the banks are giving. If those things will change, this will have an impact on the investment and finally the output. So this is the way this whole channel works. So it's basically you call it as a monetary policy framework, right? So then the question is that intermediate target is money supply, and the bank credit and the final outcome variable is either price stability or the output. And the question here is, what is the instrument through which the monetary policy can be affected, or money supply as well as the bank credit. So these are basically, we call it as monetary policy instruments. So our basic discussion is to try to find out those instruments, or the commercial banks instruments, the commercial banks or the RBI uses to change the supply of money or the bank credit. So, and finally the output variable like your price stability, inflation, GDP, all these things get affected. Now let us see what are those instruments which we use as a monetary policy instrument, right? So there are many instruments we have over the years that RBI is using as instruments for monetary policy. The first instrument which is very popular in the market is open market operations. So open market operations in the actual sense is nothing but buying and selling of the government securities to adjust the liquidity conditions in the market. The money supply or the liquidity is very high in the market, let's assume. So if the liquidity is very high in the market, then what is Reserve Bank of India can do? Reserve Bank of India can sell government dated securities. So if they sell government securities, what will happen? If they sell government securities, then they can what they can do is they will suck the money out, right, which is able to public them. Now against that, they will provide these bonds or government securities, and the money will be basically going to Reserve Bank of India. So the total circulation or total availability of the money in the economy or with the public will go down. Then obviously what will happen? It will basically reduce the money supply, and the other channel will work accordingly. The reverse can work whenever there is an illiquidity or money supply or liquidity condition in the market is very low, or there is illiquidity in the market. Then what does RBI can do? RBI of India will buy the securities from public or from the market. So if they will buy the securities from the market, what will happen? They will pay them, and against the bond, whatever these banks or other market participants are holding, they will take bond with them, and the more money will be coming to the market, and therefore money supply or the liquidity can go up. The open market operation is nothing but buying and selling of government securities to create liquidity and inject the liquidity, or to observe the liquidity from the market. So this is one of the instruments which is used by RBI to change the money supply in the economy. Then another is bank rate. So by changing the bank rate, which is very popularly used before, nowadays it is not very popular instrument. But in 90s, if you see, it was used as a very popular instrument, as a monetary policy instrument to control the money supply. Bank rate is basically a rate at which commercial banks can borrow from RBI. But the bank rate is relatively a long-term rate. The bank rate does not change very frequently. So bank rate is a rate in which the central bank allows finance to the commercial banks, or in otherwise commercial banks can borrow from central bank. So if the bank rate will increase, availability of money will go down, and bank rate will increase, then the money lending will also increase, bank rate increase over. So the money lending will increase, then the demand for money will go down, and the availability of money to the public or to the market will also go down. Then a money supply will also go down. So this is a reverse thing that can happen. Whenever the bank rate is less, the bank rate will be low, or the bank rate will be low. So there are two instruments. The other instruments are, if you see, there is one instrument called as cash reserve ratio, which is again and again used by Reserve Bank of India to control the money supply. Cash reserve ratio is, nothing but the cash in which the banks have to maintain with RBI as a certain percentage of their demand, and the time liabilities. Here, if you remember, what do you mean by this demand time liabilities? It means the deposits, your saving deposits or your time deposits or your fixed deposits, right? So certain percentage of total deposit has to be kept with RBI as a reserve. It is 6 or 7%. It varies on the basis of the liquidity conditions in the market. So here, if your CRR is increasing, then the availability of the money to the bank will go down. Then obviously your money supply will go down. So if your CRR is less or will decline, then the money available in the banks will go up, and if the money supply goes up, it is also the way, the bank RBI, the central bank, changes the cash reserve ratio to control the money supply. Another way is your statutory liquidity ratio, that is SLR. So according to your RBI guidelines, there is a mandatory percentage of total deposits what commercial banks have to invest in government bonds or the approved securities, and mostly the securities that are highly liquid, right? Certain percentage of the money should be invested in the government securities or highly liquid bonds. But the question here is why? It is so because it basically tries to restrict the expansion of the bank credit, because the commercial banks may not feel free to use their funds in whatever sector they want to use. So to increase the banks, or to augment the bank's investment in the government securities, and to ensure the solvency of the banks, which are very important. So the solvency of the banks means once a stipulated amount of money is invested in government securities, then if there is any kind of crisis or any kind of instability, the probability is there, probability is there, then what will happen? Those kind of instruments are risk free, right? They are less, there is a perfect kind of guarantor for that, because it is guaranteed by government. So in that context, what will happen? Bank can basically get out of any kind of liquidation issues or insolvency. So that's one kind of security what the bank always should have if they have invested some funds in government securities. So and as well as also control the money supply. So this is the basic objective of having SLR instruments, or SLR kind of instruments for conduct of monetary policy. Uh, there are other instruments are like your direct credit allocation and the credit. So you see, the Reserve Bank of India also controls the distribution of allocation of credit among different sectors. So there are some priority sectors. Some amount of loans should be given to these priority sectors, and there are some sectors which are highly risk sectors, right? So the loans given to those sectors should be controlled, and that is basically this guidelines with the RBI is given. So by controlling what is that they can do, they basically go for fixation of specific and direct quantitative credit ceiling, right, and credit targets. Then given the limit that how much loans can be given to a particular sector or a particular company or a particular individual, as well as which are the sectors that should get some loan, like the priority sector, like agriculture sector, small scale industries, you know, which are restricted, which restrict the drawing power of the borrowers of the cash credit limits. So certain prescribed, credit deposit ratio also already given in respect of their rural and semi-urban branches separately. So credit to deposit ratio should be at least 60%, and the credit deposit ratio can vary across different regions. Some of the banks may be, in rural areas, and some of the banks are in urban areas. So depending upon the credit worthiness of the customers or the individuals, um, or the different kind of borrowers, the Reserve Bank of India has fixed this credit deposit ratio for different type of customers. So this is what basically the one of the instrument through which they can control money supply in the system. Then we have another instrument. We have selective credit control. Now, when you say selective credit control, they are used to reduce the supply of credit in certain directions to encourage the desired direction. The basic objective is you have a very selective control to stop the hoarding. So now what is basically happening at the time of low price? Sometimes what has been observed is some of the producers can hoard that particular product by taking more loans from the banks, and in future period they can sell it under a very higher price. So RBI basically is ensuring to maintain the price stability. So what basically RBI does is, or what central bank does is, they regulate, they control the particular entity or a particular sector, in terms of providing the loans. So if the loans can be restricted, automatically it can discourage the hoardings as well as price fluctuations, and also can be controlled through that, right? The selective credit control is a very old measure. So RBI uses it as one of the monetary policy instruments wherever it is required. So the other instruments we also have is credit authorization scheme, right? So this under this scheme, the credit proposals for rupees 5 crores and above, right? In case of working capital, or 2 crore and above in case of term loans, has been submitted to RBI for the post-sanctions scrutiny, because every companies need the working capital finance, right? If an individual entity who's taking the loan more than 2 crores, then will have then what is happening for that? Also, prior approval is required or is second from the RBI, and through this process, RBI tries to conclude what kind of customer is taking loan and for what purpose this loan is given. So it has two objectives. One is to control the non-performing assets in the system, which is a very serious and major concern, as well as to control the amount of money supplied to the system at a particular point of time. So this is basically defined as a credit authorization scheme under we have certain credit monetary arrangements through which this particular mechanism works. Now, what do you mean by credit planning? That's another instrument. So, you see, each bank is required to prepare a realistic annual credit budget, incorporating estimates of the volumes, the growth of the deposits, other resources, and the demand for credit. So, that means RBI has given some kind of information or given some kind of notification to commercial banks to prepare the budget for the credit allocation, and as well as that what is the kind of deposit they are expecting in that particular year. So the forecasted figure or of the real increase in the deposits, or the expected demand for the credit, that thing, and all those details have to be prepared from beginning. And once the proposal is ready, it is subject to change, but at least the proposal from the beginning should be ready, and proper planning has to be done to ensure that the money supply in the system at a particular point of time can be very easily controlled. So in this context, if there is a proper planning which exists, then it can go to RBI, and RBI is ensuring that this is the way the money supply is going to be there in the next period. Then we have moral suasion. Moral suasion means the RBI starts writing letters or holding discussions with the banks about the trend in the economy in general, and money, credit, and finance in particular about the measures which ought to be taken from time to time in light of the different objectives. And the objectives are basically nothing but the price stability again, right? So the increase in the growth rate. So this is basically informal kind of way of controlling the money supply, because if RBI feels bank needs to be advised, or they should understand or what is the economic scenario and what kind of demand should be there, for demand should be there for the credit, and as well as whatever amount of deposits should be there in a particular system or that particular point in time. So depending upon the economic conditions, what basically the RBI and the banks decide that how much loan can be given to a particular point in time. So because of that, the moral suasion is one of the instruments which can be used. So most important instrument here, by RBI in today's context is LAF, that is your liquidity adjustment facility. So you are already aware about reverse repo rate. We have already discussed. So these are different rates which are used under liquidity, liquidity adjustment facility, or LAF. It basically manages liquidity on a day-to-day basis. So the operations of LAF is conducted by the way of repurchase agreements, reverse and repo reverse, right? With RBI being the counterparty for all such transactions. So what basically happens in a repo contract is it's an instrument for borrowing funds from by selling the securities within by selling the securities and mutually agreed future date at an agreed price, which includes interested for funds borrowed. So that means commercial banks will borrow from RBI. Here, the commercial bank will borrow from RBI with an agreement that the security can be repurchased further with interest rate, and the reverse repo rate is which is the lending of the funds against buying securities with an agreement to resell and the said securities on mutually agreed future date at an agreed price, which includes the interest rate at the funds lent. It is reverse, right? So this repo rate is charged by RBI, and the reverse repo rate is basically charged by commercial banks. So if commercial bank wants to borrow the money from for overnight basis from RBI, they want to borrow at a repo rate with an agreement that the money can be again given back to RBI. And again, if there is any expense or any kind of money which is available with the commercial banks, then RBI can take out the money from commercial bank and it can be parked in RBI. And that is basically the rate for which the RBI which pays from the interest to the commercial bank. That is basically the reverse repo rate. And the reverse repo rate and repo rate both are basically always changed from time to time by the Reserve Bank of India. So using this repo and reverse repo, a monetary policy operating procedure has been established. So in the current context, if you see, RBI wants there should be a corridor. So this is total one, which is basically your corridor, right? So here in the corridor, they have a single policy rate, that is repo rate, and in the below is the floor, which is a reverse repo rate, and above they have marginal standing facility rates, right? So overall, if you see, RBI always ensures that the money rates should be below marginal standing facility. So marginal standing facility rate is a little below, a little bit more than the repo rate. So if RBI wants to borrow and wants to lend some money to the commercial banks, or commercial banks want to borrow money from the RBI, they can borrow through MSF rate after their limit is over and the terms of the repo rate. So at a particular point in time, RBI ensures instead of going to RBI, they should go to the call money market, right? Call money market is one bank can borrow from another bank, right? That is the RBI overall ensures, that is the corridor should be maintained, and once the corridor is maintained, then whatever forecasting and the planning has been made in terms of price stability, growth rate, that will not be going to be affected in that particular period of time. So this is called as operating procedure of the monetary policy. But there are certain challenges, there are certain revisions which have been made in terms of monetary policy, that will be that we shall be discussing in the few coming slides. This is what basically we have been discussed. So there are challenges as well as the autonomy of the RBI. So now next, let's discuss on fiscal policy. Fiscal policy deals with revenue and expenditure policy of the government. The expenditure policy of the government, um, the word fiscal has been derived from the word fisc, which means public treasury or government funds. Now let us see what are the objectives of fiscal policy. The following are the objectives of fiscal policy. First, higher economic growth, price stability, reduction in inequality. So the above objectives are met in the following ways. One, by consumption control. So this is the way the ratio of savings to investment, savings to income is raised. Raising the rate of investment, taxation, infrastructural development, imposition of progressive taxes, exemption from taxes provided to the vulnerable classes, heavy taxation on luxury goods, discouraging the unearned income. So now, next we have what are the components of fiscal policy. So there are three major components of fiscal policy. One is your government receipts. We have government expenditure, the public debt. So you all should note that all the receipts and expenditure of the government are credited and debited from the following. One, your consolidated fund of India, contingency fund of India, public account of India, right? So government receipts, there is a categorization of government receipts. It can be revenue receipts. It is tax revenue, either direct tax or indirect tax. Non-tax revenue, that is fees, licenses and permits, fines and penalties. We have capital receipt in form of loans recovery, disinvestments, borrowing, borrowing and other liabilities. Also, there is a debt trap. So, situation where the borrower has to, borrow again for the payment of an installment on a previous debt. So, a borrower is unable to meet the debt service obligations without borrowing is known as debt trap. So there was a direct tax code bill introduced in 2010. So it hasn't been implemented, but the bill seeks to replace the following taxes. So Income Tax Act of 1961, the Wealth Tax Act 1957, right? So then we have disinvestment. So when the government sells or liquidates its assets of central public sector enterprise, the state public sector enterprise or other assets, it is referring to disinvestment. So this approach caters to the objective of fiscal burden reduction. So the government expenditure, in case of government expenditure, there are two classifications of public expenditure. One is your revenue expenditure, which is a recurring expenditure, that is interest payments, defense expenses, salaries to central government employees, etc. are the examples of revenue expenditure. Second, we have capital expenditure. So when you talk about capital expenditure, it is a non-recurring expenditure like loan repayments, loan to public enterprises, right? So you must know that the plan and the non-planned expenditure have been scrapped with the abolishment of, with abolishing the Planning Commission of India. So now what do you understand by fiscal consolidation? So the measures that are taken to improve the measures, they're taken to improve the fiscal deficit come under the process of fiscal consolidation. So through fiscal consolidation, the government tries for improvement in revenue receipts, better alignment in the public expenditure, right? So the government introduces the FRBM Act aiming the fiscal consolidation. So now there is an FRBM Act which is to impose the fiscal discipline of the government. So it means fiscal policy should be conducted in the disciplined manner or in a very responsible manner. That is, the government deficits and borrowing should be kept within reasonable limits, and government should plan its expenditure in accordance with its revenues so that borrowing should be within the limits. So next, let's understand the financial reforms in India. So the financial sector constitutes commercial banks, non-banking financial companies, investment funds, money market, insurance, pension companies, real estates, etc. It forms the core of an economy which facilitates the mobilization and distribution of financial resources. It is engaged in providing financial services to the customers of commercial and retail segments. So after independence, India inherited a colonial legacy, right? That was full of various social and economic deprivations. So the planned economic development strategy adopted based on the Mahalanobis model that has its own limitations started showing um, in 1980. So in order to achieve various economic goals, the government resorted to increase the borrowings at a very concessional rate, which led to weak and underdeveloped financial markets in India. Then we had seen the nationalization of banks. So the increased government control and decreased role of market forces in the financial sector. There was increased bureaucratic control, issues of red tapeism, right? Increase of non-performing assets. So turbulent international events such as war in the Middle East and the fall of USSR increased the pressure on the forex reserves in India. So, talking about reforms in banking sector. So first was the reduction in CRR and SLR has given banks more financial resources to lend to agriculture, industry, and other sectors in the economy. So the system of administered interest rate structure has been done away with, and RBI no longer decides interest rates and deposits by the banks. It allows domestic and international private sector banks to open branches in India. Like, for example, HDFC, ICICI Bank, Bank of America, Citi, Deutsche, American Express, etc. It highlights the issues pertaining to non-performing assets, and they were resolved through lok adalat, civil courts, and tribunals. The securitization and reconstruction of financial assets and enforcement securities interest act, so which is called as SARFAESI Act, right? So the system of selective credit control that has increased the dominance of RBI, and it was removed so that banks can provide greater freedom, in giving credit to its customers. Next, let's discuss on the reforms in debt market. So the 1997 policy of the government that included automatic monetized of the fiscal deficit was removed, resulting in the government borrowing money from the market through the auction of these government securities. So the borrowing by the government occurs at a very market determined interest rates, which have been the mode which have actually made the governments conscious about its fiscal deficits. And with the introduction of treasury bills by the government for 91 days for ensuring high liquidity and meeting the short-term financial needs, and that is also used for benchmarking. It also debt market is now ensures the transparency. The government introduces a system of delivery versus payment settlement, right? So now next let's discuss on reforms in the forex market. So market-based exchange rates and the current account convertibility was adopted in 1993. So the government permitted the commercial banks to undertake operations in forex, right? Participation of newer players allowed in a rupee foreign currency swap market to undertake currency, swap transaction based on, transaction subject to certain limitations. So there is a now replacement of FERA 1973 and it was replaced by FEMA in 1999 for providing a greater freedom to the exchange markets. Then another thing which is a major reform in the forex market is trading in exchange traded derivatives. So the contracts now are which was permitted for foreign institutional investors and non-resident Indians are subject to certain regulations and limitations. Now, let us discuss the various impact of these reforms that we had just discussed on the financial sector in India. So it increased the resilience, the stability, and the growth rate of Indian economy from around 3.5% to more than 6% per annum. There is a resilient banking system that has helped the country deal with the Asian economic crisis 1977 to 98 and the global subprime crisis that happened in 2008. The emergence of private sector banks has been observed, and foreign banks have increased competition in the banking sector, which has improved its efficiency and capability. So there is better performance by stock exchanges of the country and adoption of international best practices. Better budget management, fiscal deficit is better, and public debt conditions have been improved after the these various financial sector reforms. Thank you, everyone.